sent someone today some bullet points as to what I think the Retail Investor Protection Act should have. Let's see here. Should we add more to those? Wasn't that one? Where was it? I gotta go back. Who did I share that with? I wrote somebody. Where are you? Wasn't that one? Wasn't that one? Wasn't that one? Was it this one? Oh, that's not that one. Crap. Where? I wrote like a 55 paragraph long thing and I sent it and now I can't find it. Did I send to Alex? Did I send to Alex? What the fruit? Sorry, one sec. Did I never hit send? It says I did. Oh, it still says sending. Okay, well that doesn't help anybody. No wonder it doesn't pop up on the desktop. But basically, okay. So, number one, end naked shorting of all kinds for all participants. Make the fines 150% of the value of the security sold and not delivered. Make 3-strike rule that if naked shares are sold 3 times, the fund, individual, market maker, institution, etc., loses their license. They no longer have access to any of the securities markets. They can't be trusted. Moving on. You guys lose your license. Number 2, end dark pools. No one should be allowed to make deals that aren't visible to the rest of the market, and payment for order flow along with this. So, end dark pools, period. Every stock bought and sold should go through the market. This even means special acquisitions, right? If you have a company that's like, hey, I want to buy 100 million shares of your company, and I just want to like do a special deal with your company, no, put it through dark pools. Everyone should see what's going on. I mean, if you buy a house, you still have to report the sales price to your county assessor, right? Like they record the sales price. It goes into the MLRS data, whatever it is. So yeah, keep doing that. Hey, Anonymous. All right, we got to 500. We're halfway there. Woo! Thank you. And high frequency trading. It's only used for manipulation arbitrage and offers nothing to the markets as a whole. Retail has no access to supercomputers that do high frequency trading. Unfair advantage. Once a stock is purchased, begin a 5 to 10 minute clock until you're allowed to sell again. The same share can bounce back and forth theoretically millions of times with high frequency trading, manipulating the price, doing strange arbitrage shavings. You and I don't have a supercomputer that can do that. And therefore, slow it down. Just slow the market down. Eliminate high frequency trading. Take away a whole bunch of this weird phantom volume that can happen on shares and make it a logical market. If you buy a stock, you have to hold on to it for a few minutes before you're allowed to like day trade it away. It will make people think a lot more about what they buy. 4, members of Congress and their families not allowed to trade securities. That one's pretty obvious. 5, regulators cannot hire from the private sector. And if the government regulator moves to the private sector, they cannot come back. One and done. That's it. A reduced margin by a lot. Currently stands at an unsustainable 30 to 1. Should be more like, say, 3 to 1. These hedge funds should not be able to leverage away everything to make these silly plays because there's too much margin out there. And all these banks, Goldman Sachs, JP Morgan, they know it. They've got 4,000 or 5,000 hedge funds and family funds under every single one of these investment banks, and they're over leveraged to the tune of trillions. And they know that if there's a hiccup and 1 or 2 of these hedge funds go down, these banks are done. It will just cascade through the entire market. The potential energy turning into kinetic energy will be enough to eviscerate the global financial system. 7, break up the banks. There should be several dozen investment banks in the U.S. and 100 plus major commercial banks. No bank that should be too big to fail. Just don't let them be too big to fail. 8, all institutional and fund positions should be visible. This includes short positions and family funds. If we require someone to report a long position in a company, we should also require them to report their short position. We should see what everyone's short position is at all times. We can see when Ryan Cohen takes a 9.9% stake in Bed Bath & Beyond, why shouldn't we see when Knight Capital takes a 30% short stake, right? Let's see it. But none of this self-reporting crap require the reporting. Anytime a short position is made, a press release goes out. Short position, some 8K filing, whatever. And 9, something that would entice dividends over stock buybacks. Stock buybacks are a tool shorter companies can use to bolster the share price, but too often that money that should be used on R&D, maintenance, improvements to the company, etc., or as dividends for shareholders are used to jack up share prices so executives meet price thresholds for bonuses. It bleeds companies of capital and results in neglect, like the baby formula shortage we suffered last year. You guys remember? We almost ran out of baby formula in America. Why? Because there's 2 companies that make baby formula, and one of them did $5 billion in stock buybacks rather than do maintenance on their machines at their factory. The machine started pumping a whole bunch of bacteria in the baby formula, making it toxic and would kill babies, and they had to stop selling baby formula. If they maybe had spent $5 billion on improving their factory, then, we wouldn't have had a baby formula shortage, and there wouldn't have been a whole bunch of babies that were starving. So, no, that's my list of 9 things. If you guys want me to put more in there, let me know. We're starting to try to put together sort of the framework for legislation for the Retail Investors Protection Act, and those are the main points I have right now. Kiffle, thank you so much. We're at 550. We're over halfway. 55% of the way to our goal. Fantastic. Yeah. Okay.